Hello, good morning everyone, and welcome to our final BDO Back to Business presentation series. You would have heard over the last 6 weeks from a number of experts within BDO about some of the impacts on their particular areas of COVID-19. And this morning you're going to be hearing from two of our financial reporting specialists, James Lindsay and Natalie Tyndall. My name's Chris Neves. I'm one of 6 audit partners within the BDO Auckland office, and I've got the pleasure of working with both James and Natalie on pretty much a daily basis. James is the head of our IFRS advisory services. James's team go through and advise clients in respect of IFRS projects. Typically the new standard on leasing is obviously front and foremost of a lot of clients' minds. Natalie works in our professional services group and is a key member there. The professional services group not only supports BDO internally, it also supports clients up and down the country, again with the full gamut of accounting frameworks. Together, the 3 of us have probably got over 60 years worth of financial reporting experience, although we have asked around, and this is the first pandemic we've actually had to deal with. So yeah, please bear with us. The format of the morning, we will kick off with a 30-minute presentation from James and Natalie, and then follow that up with a 30-minute question and answer session where we'll invite you to put your questions through to us, and hopefully we'll be able to answer them. And so without further ado, if I can pass over to James. James.
Thanks, Chris. Good morning, everyone. Welcome. It's a pleasure to be presenting to you today on what will no doubt be a very interesting series of topics. What we're going to cover today, as the title of the webinar suggests, is we're obviously going to be having a look at how revenue recognition and asset impairment is affected through the lens of the COVID world that we now live in. But before we sort of dive into that, I thought it would be useful just to step back for a second and frame up kind of the end game around why these 2 areas are important and why an entity's financial statements overall are important in terms of what they're trying to achieve, what's their objective, what's their mission, and how that relates to the 2 topics we're talking about today. So if we kick off into the next slide, the end game. What's the end game? Well, really, the end game in this context we're talking about today is the financial statements of your entities. Now, when it comes to financial statements, some people, you sort of sit at 2 ends of a spectrum here. You either see your financial statements as a necessary evil, a compliance activity that you have to deal with every year, or at the other end, some people see them as a piece of collateral that they like to showcase their entity, how it's done, where it's going, what it's doing. But irrespective of where you sit on that spectrum, what the financial statements are doesn't change, it stays constant, and that includes in the current COVID world that we live in. So what are your financial statements? Well, in essence, they're simply a snapshot, a glimpse at a point in time of your entity across all of the 6 things up there on the slide. Really what it is, it's a reflection of the world through the lens of your entity. There's a story to be told in the financial statements, and for 2020, that story is no doubt going to need to include some new chapters and some rewriting of some existing chapters we've had in those accounts in prior years. So if we move on, in terms of what happens when the world changes. So if the financial statements are a reflection of the world through the lens of your entity, what happens when the world changes? Well, as I sort of alluded to on the last slide, certain aspects are going to need to be revisited on how they're presented and ultimately how they're reflected in those financial statements. Now, when we talk financial statements and what needs to be reflected in them, everyone on this webinar will know that sitting behind your financial statements are a whole bunch of accounting rules, those dreaded things we call accounting standards. And they sort of drive and set the framework around what needs to be in them and how they need to be reflected. So when the world changes and we need to revise our reflection of the world, in the current world we're in a lot of cases we're going to need to go back to school, and that includes, you know, people like me, Nats and Chris, dust off the school books and look at some things that maybe we haven't looked at ever or before in the last few years while the times have been good. And then we start the journey down the path of transformation, transforming the prior year's accounts, the prior year's status quo into the new world and what that needs to reflect. So if we move on, we can start looking at COVID and what are some of the hit points that COVID brings into our financial statements and financial reporting process. So we've got our little COVID friend over there on the left of the slide, firing arrows into our new world reflection. So what to say? So COVID, hopefully, touch wood, is going to be one of these once in a lifetime events that's around for a short time, not around for a long time, and hopefully never again. Obviously, operationally, COVID's been disruptive and obstructive across a wide range of business operations. And that's no different when it comes to the preparation of your 2020 financial statements with COVID in mind. But talking more specifically about what some of these COVID hit points are, there's some fairly obvious ones up there. COVID obviously impacts the way that entities go about their core business activities. And that obviously includes top line money that's coming in the door, so revenue, the amount of revenue coming in. When you start to have decreases in revenue coming in the door, the carrying value of your assets on your balance sheet start to come into question. Do they still hold their value? So asset impairment a hit point. And then some other sort of common ones that people will be grappling with at the moment, no doubt, going concern, entities' ability to continue trading beyond 12 months, questions asked around that. And then if the answer to that question is no or unlikely, that then triggers a whole nother raft of separate hit points. Start to see a waterfall happening there. Going concern is still something that's still going to be a going concern going forward, but you may have some business restructuring that needs to be done. That's in the mix. That triggers a whole bunch of other hit points, new things that need to be dealt with. And then there's a laundry list of other ones that are far too long to go through on a 30-minute webinar. So for this webinar, we're just going to focus on those top two in red, revenue and asset impairment. So we move through on to talking about our first topic, revenue in the new world. So as it suggests up here, and as we've sort of alluded to on the previous slide, revenue is a very important number. It's really, in terms of the financial statements, where everything starts. Every subtotal in your income statement is at its mercy, ultimately getting to a bottom line net profit number. Where does net profit end up? That goes through into retained earnings and equity. So that's even more subtotals in your balance sheet that are impacted. But stepping back, what is revenue? What are you trying to reflect in your financial statements with the line item called revenue? Well, revenue is supposed to be a reflection of income that's derived from your entity's customers in the ordinary course of business, i.e. selling of goods, providing services. Revenue, and I don't like using this word, but I'll throw it in there, has a commerciality about it. It's supposed to reflect what you get or what you're owed for doing what you do. So stepping back, putting our COVID lens on, what parts of revenue accounting could COVID touch that you may need to be wary of for your 2020 year ends? The first point up there, the blue box, is there actually any revenue to recognise at all? And this comes back to the point of accounting standards saying that you can only record revenue and an associated debtor, in this case, for your credit sales, if at the time of the sale, the time of the transaction, it's probable that you're ultimately going to be paid. And this is where that commerciality comes in. It has to be substance. So if you're not going to be paid for it, you don't reflect the revenue in your accounts. In practice, during ordinary trading and good times, it's fairly rare that this would ever become a question. You do see it occasionally in areas such as where there's new clients you're selling to on credit, where you don't know what their credit history is, whether they're ultimately going to be able to pay you. But more so when you're trading into unstable economies, countries with government issues, war, etc., where you don't know if the company is going to be able to pay you or may even be around in a few months or weeks' time. But the point there is, in ordinary times, where you're trading on good faith and good terms, it's probably probable that there's the expectation that you will be paid, so it doesn't so much become an issue. And then ultimately, if things change and your customers don't pay you, there's a doubtful debts process that you go through to write down your debtors. But the point there is that original revenue that you recognised up front stays recognised in your accounts. At the time you made the sale, it was probable you were going to get paid, you still get to book the revenue. So what does COVID bring in? Well, COVID kind of changes that status quo. It's not to say that parties won't be trading in good faith, but for some of your customers, it may be that the likelihood of them paying you for those credit sales is now slipped to somewhere below probable. And where that's the case, the accounting standards say you can't recognise or reflect that revenue until such time as that uncertainty around being paid has been resolved. And usually that means when you've actually received the cash. So what that can do is essentially push revenue potentially between periods, from when transaction occurred in one period to when you might have actually received payment. So that's all well and good, but how do you go about assessing that and determining which revenue you should and shouldn't recognise? And this is where going back and looking at your debtors aging can be useful. Debtors aging pre-COVID, if clients weren't paying you or were slow paying you before COVID, chances are that COVID may now be, exacerbating that. So maybe that revenue is not legit. Equally, after COVID, if your customers have suddenly stop paying you, maybe the credit sales made after the lockdown aren't actually counting revenue, so to speak. And also having a look at bad debts and credit notes that you've issued since all this COVID stuff's kicked off will give you insight into whether there's revenue to be recognised for those transactions. So in terms of the red box, the amount of revenue, I'll throw over to Natalie to take us through that.
Right. Thanks, James. Good morning, everybody. In the current climate, it is really important to understand what has been agreed in your contracts with your customers. Is there any way that the amount of the overall end revenue you've agreed with that customer could change, either contractually or through customary business practices? In other words, is there variable revenue? This could be items from things like performance bonuses for early completion. Alternatively, it could be penalties for late completion. It could relate to customer incentivizations, buy one, get one free type issues, or it could also be the implementation of early payment discounts. You need to carefully consider the impact of the economic downturn because of COVID, and also the impact of the lockdown on these terms and conditions, as this may impact the amount of revenue you're able to recognize. James, would you like to take everybody through onerous contracts?
Thanks, Natalie. So onerous contracts, just a quick point here on these. So when we're talking onerous contracts, we're talking about those contracts that are going to cost more for an entity to satisfy than the cash that's going to come in the door for satisfying them. And it's important to note that we're talking about contracts where there's a firm commitment. So you've contracted up front to sell a set amount of goods for a set price. So there's a contractual commitment for you to deliver. So the accounting rules are quite clear on this. At the point in time where you deem that situation has arisen, that you're going to spend more to satisfy a contract, it requires you to book the expected loss on that contract up front at that point in time. The point in time it's assessed as being onerous. So in the current climate in the COVID world, COVID obviously introduces a number of variables that could result in this situation. Talking on the cost side, in terms of driving costs up, scarcity of materials, reduced supply of logistics and freight services are things that might push up input costs. That's what you're really looking at here, the input costs, as well as the cost of obviously your inventory. But another point to keep in mind is what Natalie's just spoken about, the revenue side of the equation. These contracts are subject to variable revenue, and that revenue amount has now decreased. That may now push the cash coming in the door to a position that in the future that's now below what it's actually going to cost to satisfy that contract. So onerous contracts are definitely something that a COVID-like situation starts to throw into the mix. So Natalie, over to you to talk on our last point up there, government support.
Yeah, I've been receiving a lot of questions lately about the so-called revenue from government support, such as the wage subsidy. What's really key to note here is that government support is not revenue as defined. It is actually a government grant, and it is accounted for under a completely separate standard and should be shown as other income. So when you're looking at government grants and government support, it is not revenue. So it's a completely different standard and different accounting rules apply. So just keep that in mind when you're doing your year-end accounts. Thanks. Moving on, Charlene.
Okay, so moving on to revenue, let's start talking about assets in the new world. So things to remember, assets are things, resources that entity users ultimately to make money. There's a value to be reflected in the accounts associated with these. Assets include both your quick, high turnover assets, examples up there on the slide, debtors and inventory, but it also includes those fixed long-term assets that are held, that are used on an ongoing basis to drive, run the business. So when COVID hits, the carrying amount, the value of these assets starts to come into question around their ability to bring cash into the business. And it's a matter of stepping back, reassessing the value that should be reflected in the accounts around these items. Does it still hold? And if not, do we need to write down these assets, i.e. impair them? How impairment is driven, or how impairment is determined for assets is driven by which accounting standard applies. So the two up there, debtors and inventory, they actually have sort of built-in impairment tests within their own separate accounting standards that cover them. So that's where you look there. For the fixed assets over there on the right, those of you that have looked at this in the past, particularly those around impairment of goodwill, will know that there's a completely different standard that applies when you're looking at impairment of these fixed longer-term assets. So this is what we're going to look at on the next slide separately. And on the next slide, we're going to have a quick discussion about debtors in the new world. So the thing around debtors is similar to the thought process that we sort of spoke about when it came to revenue. Year end, we're revisiting the value that's reflected. Are we still going to likely receive the cash from our customers for the goods that we've sold on credit or the services we've provided on credit? But then the question is, how do we know what value and where do we look to determine this? I guess the key point to say here is it's a matter of some educated guesstimates, and the key word there is educated. And when it comes to debtors, we're looking at it on two fronts, and this is the point that entities need to keep in mind. The debtor specific, as well as the wider economic factors as well. So we talk about the debtor specific ones just quickly. What we're talking about here is again, looking back to your debtors aging pre and post COVID. What was the status of your debtors repayment history prior to COVID, and is there anything there to tell you about how COVID may have impacted them going forward, being they weren't paying you beforehand, what's the likelihood that they're going to be paying you after? And equally for those ones that have suddenly stopped paying you after COVID's hit, whether that's sales that you've raised before COVID or after COVID, does that tell you anything? But really looking at it through the lens of specific debtor impacts around whether you're likely to get that cash in for those sales. Natalie, I'll leave you to talk on the wider economic lens.
Thanks. Yes, and under NZFRS, it's really important when assessing financial asset impairment to also look further than your individual debtor circumstances. You also need to look ahead to what's happening in the wider economy, be that in New Zealand or further afield, depending on facts and circumstances. How much do you know about your customers' customers? Because what is impacting those entities could have a direct correlation on the recoverability of your debts. For those of you that have special purpose reporting requirements, it's not as onerous for you. You don't necessarily have to look at the wider economic impacts and characterizations of going on, but you still do need to consider whether or not your debtors will be paying you. If we move on now and have a look at inventories, the impairment requirements for inventories are contained within their own standard. Inventory is required to be carried at the lower of cost or net realizable value. So what is net realizable value? Net realizable value is the sales price in the ordinary course of business, less the cost to complete that sale. So with the economic downturn due to COVID, what is the impact and what is the new ordinary? What is the impact going to be on your sales price? And what is the impact going to be on your cost to complete your finished goods? It's easy to determine your net realizable value if you have a firm sales contract, because the net realizable value will be as detailed in that contract. If you don't, however, have firm sales contracts in place, you're going to have to spend more time on analysis as to what you believe the net realizable value of your goods will be. Consider, for example, if you're a manufacturer, what are you selling? In the good times, you would have sold a finished product. That finished product would have been made up of multiple raw materials. In the good old days, if one of those raw materials had a net realizable value of less than cost, it wasn't really an issue and you didn't really have to go and account for that impairment in that raw material, because you would look at the end product you're selling. And if the finished good overall had a higher net realizable value than cost, you didn't have to account for any inventory impairment or obsolescence. Now, however, with the global economic turndown and the impact on the economy here in New Zealand, you need to have a look at, can I actually sell my end products, my final goods? Is my market still there, or has it reduced in volume? If it's reduced in volume and I can't sell lots of my end product, I might now be forced into selling my raw materials, which means you now have to look at a far more granular level at net realizable value. So that's something that you might need to consider at your entities as well. One other thing that I'm also often asked about is, do I really need to look at every single line item on my inventory ledger? And the answer is not necessarily. The standards do allow you to group items as long as they have similar characteristics and they are like items. Of course, you can then get into arguments as to how like is like, but that's a question for another day. I will now hand over to James again.
Thanks, Natalie. So moving on from inventory, now we can start talking about those fixed assets. But before we get into that, we'll just make a quick distinction here. How and to what extent fixed assets are impaired depends under which accounting framework you're preparing under, whether you're IFRS or your CAN special purpose. But we'll flag that out as we go through the different points on the slide where there's differentiation. But the point to highlight here is this is unfortunately where impairment testing gets complicated when we start talking about these assets. This is where you start to hear terms and words like discounted cash flow, DCF modelling, which is its own separate area of specialty in accounting. And it's not one that you can scratch too far below the surface on a 30-minute webinar, but we will highlight some key points here for the COVID world where they're relevant. We did actually issue a publication recently specifically on this. The link to that's at the bottom of the slide there, and we'd encourage you all to have a look at that after the slide. But let's go through some of the key high-level hit points when it comes to impairment testing of fixed assets in the new world. So Natalie, I'll let you talk to the first 2 points there.
Great, thanks, James. So the first thing you need to work out is which assets need to be tested for impairment. And there are different rules for different types of assets on your trial balance. Some assets, such as goodwill and intangible assets with indefinite lives, have to be impairment tested every year, regardless of what's happening in the economy. Other assets, such as property, plant and equipment, and rights of use assets on leases and other types of intangible assets, are only tested for impairment if there's an impairment indicator. Now, whether or not COVID-19 results in an impairment indicator for your entity will be fact dependent on your type of entity and the industry in which you operate. If you are a hand sanitizer manufacturer, I would argue COVID-19 is not going to be an impairment indicator. However, if you are a hotel operator, it very most definitely will be. The second thing you need to look at is at what level do you test for impairment? You need to look at the group of assets or single asset and look at if it can generate cash flows that are independent and identifiable. I'm sure you've heard of the top-down, bottom-up approach to impairment testing. So what that means is that, for example, an investment property company with multiple rental properties, you're probably looking at each individual rental property to determine impairment. If you're looking at a chain of supermarkets, each individual store is likely to be the area that you look at impairment of. However, if there's been an event in that particular store, for example, let's say there's been a flood and the freezers have all been damaged, you then need to look at the granular level at the freezer level for impairment, because there's actual damage to those property, plant and equipment items. So that's quite important. James, handing back over to you.
Thanks, Nellie. So looking at the third point there up on the slide, determining the recoverable amount. So when you're doing an impairment test, the maths of it is you're comparing the carrying amount of the asset or the group of assets to the recoverable amount, the amount that they're valued at. And there's two approaches for working out what that recoverable amount is. And the one that you use ultimately is based on how you're determining or how you're going to be using or realizing the value of that asset or group of assets. And there's two ways to do that, either through sale, so you're going to sell the asset or group of assets. And when you're in that situation, the method that you can use is one that they call the fair value less cost to dispose. So what's the true market value of that asset or group of assets to a market participant, and that's their recoverable amount. But the more common one you see, and the one that most of you will be using or looking at, is when it's through use. So you're going to keep the assets, hold them and use them in your day-to-day operations. And that's called the value in use method. And that's where you start to have to model out forward-looking cash flows, and things like DCFs come into the mix. So, and that's all about working out what's the present value of the net cash inflows of using the assets today, and how does that compare to the carrying amount that's reflected on the balance sheet. And that's the one that's far more common, and the one that I'll talk more to when we talk about step 4 now around assumptions and estimates. So think of DCFs like your entity's budget. Pull them together requires the use of some more educated guesstimates. So trying to model movements in revenue and expenditures and capital expenditure, what long-term growth looks like, both in the forecast period and beyond. The discount rate that you're going to use to discount all the cash flows back. That's a fairly fundamental estimate that needs to be determined. These are all things that need to be built into your impairment model. And as mentioned, it's a specialist area of accounting. There are templates and guidance out there on how to do it, but where the rubber hits the road is the execution of it is the challenge. And this is something that was mirrored in Kansas' recent 3-part webinar series on impairment. That was their key takeaway, that impairment and DCF testing is a specialist area, and entities should be reaching out to specialists to assist with it. So in terms of the overarching 2020 speed bumps, what is COVID going to do to impairment testing? Well, the first thing I'd say is it's going to flip impairment on its head. Firstly, there's probably going to be more assets thrown into the mix. So in the past, you were impairment testing those mandatory ones. Potentially now there's new ones coming in that now have indicators of impairment. This may mean that entities need to prepare additional DCFs or more granular DCFs or DCFs for the first time. Secondly, obviously, prior year assumptions and estimates are going to be needed to be re-looked at so that they reflect the COVID world that we live in. Obvious one, obviously, revenue projections probably going to be a bit lower for some entities. And thirdly, and this is the point that entities often miss, is it's not just to say that for each asset or group of assets that only one DCF is done. COVID throws in a lot of uncertainty around when and to what extent the rebound in revenue growth is going to occur. And where that's the case, entities might need to run multiple DCFs to get multiple recoverable amounts under different scenarios, and then apply some sort of probability weighting to get a weighted average, i.e. more accurate recoverable amount. Again, it's all about more educated guesstimates. So if we move on, I think we're at the end and we've just got a couple of key takeaways just to bring everything back. So the first one there, remember what you're trying to do. So remember what you're trying to do is reflect the world through the lens of your company and your financial statements. Step back, tell the story. How does COVID impact your entity? How does it reflect your revenue recognition, your impairment of assets, and all the other hit points that might be relevant to your entity? In terms of revenue, just remember there's commerciality around it. You're trying to reflect the true commercial inflows that are coming into your entity, and also some of those other COVID-specific impacts like onerous contracts, changes in variable consideration, and making sure that government income support isn't reflected as revenue. Assets, as we sort of just said, it's all about making sure that the value on the balance sheet is reflected correctly. Does it truly reflect future inflows that can support them? Have a look at the indicators of impairment for those assets that haven't needed to be impairment tested before. And remember that obviously with the amount of uncertainty around what the future is going to look like, that might be more than one impairment model needs to be put together. How to approach it, final point there, just some key points around that is the new world, COVID world, is not the world that we're used to, and it's not even necessarily the world that we're trained for. It may not be the norm going forward, and it may not be the norm. Definitely, it hasn't been the norm in the past, but it's here now. There is potentially some particularly complicated accounting that needs to be done, and some specialist areas of accounting to be engaged in, as sort of emphasised by that as impairment webinar the other month. So, key point: reach out, engage with the experts and consultants, ask questions of your auditors. You are not alone, and there's people here to help you through this disruptive time. So I'll throw back over to Chris if you had any closing thoughts to round us out on the key takeaways.
Thanks, James. Thanks, Natalie. Yeah, pretty difficult topic to kind of get through in 30 minutes in terms of some of the impacts of COVID on your financial reporting. I guess the key thing for me, which I'd like to kind of impress on the attendees, is to really pay some decent amount of time looking at your financial statements and thinking about what disclosures should be going in there. Your readers will be thinking about COVID. They will be thinking about how that is impacting your business, and the financials are a great place to be able to describe that. So yeah, James has touched on it during the presentation, but certainly that's something that I'd really encourage people to do. So now I'll open the floor up to some questions. There we go. There's the slide with the nice hands up. There is a question that's been posted in respect of the money from the small business cash flow loan scheme in Xero, and how do you go about posting it? I'll put my hand up as well and say, look, I'm not a Xero expert, but in respect of the money that's come through, as it says, it is a loan. The loan should actually be going through and sitting as a liability on your balance sheet. If you need some more specifics in respect of that, and I'm thinking about codes or where exactly to put it and map it through to your financials in Xero, maybe if you can drop me a note at the end, and I'll get back to you, and I'll get one of my business service persons to have a look at that. Natalie, I think you had a question that got asked to you before the presentation, which you thought you might cover.
Yes, I did. Thanks, Chris. I received an email from a client asking, does one need to look at impairment in isolation, or do you need to agree it to budgets? And unfortunately, no, you can't look at impairment in isolation. Your impairment calculation and your discounted cash flows should be very closely correlated to your forecasts and your budgets, and those should all tie in. So yeah, unfortunately, it's not something that can be looked at in isolation. There's another query that I see there is, can we use from Anonymous, can we use the wage subsidy against salary costs? Yes, you can. IS 20, Government Grant Standard, does allow you to offset your government grants received against the underlying expenses when they are incurred.
James, did you want to take the question?
I've got a few questions that have come in from people prior to the webinar on revenue. And the question is, bring it up here so I'm looking into the camera. If, say, I'm a construction company that is recognising my revenue over time, and I now have to reduce the total amount of revenue because of, say, penalties that I will now incur or a bonus I won't get, do I have to adjust the amount of revenue I have recognised prior to COVID? That's a really good question, and quite a relevant one for probably a lot of entities on the call that are recognising their revenue over time. Simply put, the answer is yes. The assessment around whether variable revenue, like penalties and bonuses, is highly probable. It is made based on facts and circumstances that exist as at balance date. And then you would need to make sure that the revenue reported for the entire year in those financial statements at that balance date is adjusted for this. So it's not just something that you true up and adjust from the date that you've assessed that the bonus or the penalty kicks in. You've got to remember again that your financial statements are a reflection of, in terms of the balance sheet, the position at that point in time, but in terms of the profit and loss, the revenue that's actually been commercially earned over that period. So if you're now saying that there's a bonus or a penalty that's in play based on what's facts and circumstances at year end, and that impacts the total revenue over what's left of the contract, then obviously that impacts the revenue or the portion of the revenue that you should have recognised for the current year. So the year ends 31 March 2020 and beyond. The impacts of COVID are very, very much in the mix at those dates. So entities with overtime revenue recognition for 31 March, 30 June and year ends beyond need to go back and have a look at, do they have any variable revenue changes in the total amount of revenue that they're going to recognise, and based on what they've recorded so far in the GL, do they need to unpick and re-put in the correct amount of revenue based on the current facts and circumstances. Another one I have is about onerous contracts. And the question is, why do I have to book the full amount of the loss from an onerous contract up front? I thought accounting standards didn't let you pre-book losses. Again, a very good question. The long answer to the question is, the thing to remember with an onerous contract is that they only arise from a firm commitment contract. So being a contract where you've agreed up front that you're going to provide X units for Y dollars in the future. So when those contracts become onerous, recognising the loss up front is all about communicating through numbers to the readers that are out there reading the accounts, that out there in the ether, company is party to a contract that they've committed to, that ultimately they're going to incur a net outflow of economic resources. They're going to cost them more money to satisfy it than money than they get in the door. So the period where that becomes apparent in terms of the accounting standards is where that loss needs to be recognised, communicated and reflected in the accounts. So that's the long answer. The short answer is because that's what the accounting standards say. Kind of them's the rules. That's how onerous contracts are and must be accounted for.
Yeah, I see there's a few more queries coming in about the government grant wage subsidy and how one accounts for it. The standard basically says when you receive it, you recognise it as a liability, and then you release it to other income as you incur the underlying expense. So if you receive it all in your financial year 19, but it will cover some of your wages in FY20, you do not recognise the full amount in FY19. You only recognise that portion that relates to the wage subsidy for the wages of FY19. So just be aware of that. There's also a question asked, is it taxable? My understanding is that it is not.
Yeah, I guess I'll jump in there, Nat. Along with my comment earlier that about the coding into zero. If it's a specific question, obviously unfortunately we're not tax advisors, but certainly we know some people who are. So please do send it through to us, and we'll come back to you and confirm that answer. There's a couple of questions there. Some questions. So somebody's been quite persistent in respect of it. In respect of COVID-19, what sort of disclosures have you seen in practice? So COVID-19, the disclosures have changed over the course of December year end to the March year end, and then they'll change again in respect of June. If you think about James's comments that the financial statements do reflect a particular point in time, the fact that they're changing does actually make perfect sense. The March year ends, there's been a number of listed companies now going through and having done their full financials. We've gone through, we've looked at a variety of those. Something like Z Energy actually stands out to me as an entity where it's gone through within each section of the financial statements where COVID has had an impact. So if you reflect back on James's comment on your debtors, you look at your fixed assets, you look at your goodwill, you look at your customer relationships. Z have put a comment under each of those notes, but they've also pulled together, if you like, a full story of the impact of COVID on their business within the critical judgments and estimates area. And in there, they talk about the ongoing business impacts and that flow through into the financials and their going concern as well. So I would certainly encourage people to look at something like Z as a bit of a kind of benchmark, but it's making sure that each area of the financials you think about, has COVID had an impact? Would a reader expect COVID to have an impact? And if COVID hasn't had an impact, absolutely say that and just state the reasons why. Nat, James, have you picked up another question?
Yes. Indeed, there's a question here. Could you please clarify whether the wage subsidy is reported as other income or is a reduction in wage expenses? James said one and Natalie said the other. That's 100% correct, because there's actually an accounting policy choice you have in the government grant standard on that. So you could either show it as other income, or you could just offset it against your wage costs and reduce your wage expenses.
Okay, we've got a question here around the difficulty in forecasting revenues and cash flows. And the question is, what is your audit approach going to be to gauge the reasonableness of the underlying assumptions, thinking specifically about impairment testing? So I'm happy to make some general comments, and then maybe Chris, if you jump in, given you're the auditor on the webinar, about what you've actually seen in practice. In terms of the difficulty in forecasting revenue and future cash flows, absolutely, yeah, that's definitely in there with COVID. What the accounting standards would want you to do, and in particular what the disclosures around impairment testing want you to do, is provide some sort of sensitivity sniff test sense check. So for the key variables and parameters in those impairment tests, so cash flow forecasts might be one, the discount rate you use might be another. Playing around and tinkering with those to see, you know, if I change my revenue outlook from say 2% growth to 1% growth, what does that do to my number? At what point do I start to look like my recoverable amount's going to dip below my carrying amount? So the accounting standards do build in that requirement for you to do some sort of reasonable sensitivity check and then disclose information to the readers and the notes of the accounts about that and what the impacts of those are. Chris, around the audit approach, is there anything you've got to add on top of that?
Yep, sure. Maybe I'll just pick up on the comment that you made about the sensitivities, because that's a very key point. Because basically nobody really knows exactly what's. Nobody's got a crystal ball in the best of times, but certainly within the COVID environment, that crystal ball gets a whole heap murkier. But from a disclosure point of view, the disclosures can kind of help with that murkiness to a certain extent. And by that, I mean, where you have got sensitivities and if a particular assumption that you're making in terms of, say, revenue or gross margin turns out to be wrong and could be reasonably wrong by something that could be foreseen. So I'm thinking about revenues could drop for another 5 or 10% for a elongated period, and if that causes impairment, then within the financial statements you should be making those sorts of disclosures. From a audit perspective, auditors love dealing with history, so trends and things like that in the past. That should very much be the basis of your impairment model, but then overlaid on that is your best guess or most likely estimate of the impact of COVID on your future forecasts. And by that, I would, we're now, if you were a March year end, we've now got a couple of months worth of actual data in terms of sales, and sales are going to be the key element behind your forecast. So we would start looking at your actuals and saying, well, what has COVID done to your business? We would also, on occasions, drop down deeper and lower into who are your customers, who are your customers' customers, just to understand that robustness of the income and yeah, the support going forwards. But ultimately, if things are tight, disclosure does actually solve some of the problems and issues in terms of what goes into your financials and how exactly do you model out something that nobody really knows what the answer is exactly going to be.
Right, I see there's a question here from Rachel. Is impairment of assets necessary when preparing accounts under SPFR or just IFRS? Well, it depends on what type of special purpose framework you're reporting under. If you're talking about the Chartered Accountants Australia New Zealand SPFR framework, then yes, impairment is necessary for some assets, not all assets. If you're reporting under a different SPFR framework, it will depend on the requirements of that framework. If we're talking about Chartered Accountants Australia New Zealand framework, there's specific requirements for impairment re debtors. But if you're talking about things like property, plant and equipment, you're lucky that if you intend to use that asset for the entirety of its life, even though there's an impairment indicator, you don't need to do impairment on the property, plant and equipment item. Goodwill as well doesn't necessarily have to be tested for impairment because you can choose to amortize it. So it's really going to depend on what asset you're looking at and what special purpose framework requirement you're looking at.
I've got a couple of questions here, one back on impairment testing and another one on onerous contracts. So the impairment testing one first. Does this year's financial cash flow forecast for impairment suffice, or does it have to be for a longer term? To answer this question is we were sort of starting to get into the nitty-gritty mechanics of what DCF cash flow forecasting is. So I have to talk about it at a high level. When you're putting together these DCF models, the accounting standards are quite clear that for the first 5 years down the track are years where you have to specifically forecast the cash flows. So you can tinker around with trends in revenue and expenses specifically for each of those 5 years. In good times, people simply just would do maybe a 1 or 2% standard growth each year for revenue. Obviously now with COVID, there's probably going to be a bit more specificity, if that's a word, or granularity around the specific cash flows, both on the revenue side and the expense and cost side for each of those 5 years, say. So the next year looking out is probably going to look very different to years 2 to 4, or maybe depending on your business or your industry, the next 2 years are going to look very different, A, from each other, and B, from years 3, 4, and 5. Beyond year 5 is where you start to get a bit more technical and we start talking about what's the terminal value, what's the present value of the cash flows from year 5 out to infinity. And that's at the point in time where you take the year 5 cash flows and discount them out as if they were annuity out into the future. But to answer that question, it's not just the current next year's cash forecast that you need to look at. It's at least the next 5 years. In terms of the onerous contract, we are a service providing firm, so they don't record WIP on balance sheet. However, we have some onerous contracts. Are we able to recognise the losses related to these contracts? Short answer to that question is yes, with the disclaimer, so long as it's a firm commitment contract. So you have to deliver services in the future at a set price that's not going to change. If you're a service providing firm, it obviously probably depends on two things: whether that contract's onerous to begin with, whether there's variable consideration, bonuses, penalties, etc., that are now in the mix, and also whether there's an increase in costs, whatever they may be at the other end. But when you step back, if the revenue is going to dip below the costs, and that's a firm commitment, then that contract is onerous, and the requirement is that you need to book the loss for that contract up front in the current year. Okay.
Thanks for that, James. We're getting quite close to the 10 o'clock kind of close off, so I'll maybe just take the last question that's up on screen, which is have the IRD or MSD commenced any audits of any BDO clients in relation to the wage subsidy? Not that I know of. Yet certainly I'm not aware of anyone having had one of those audits been undertaken. However, in terms of the background, I think those audits will happen. And the reason I say that is BDO obviously is an audit provider, have been in contact with the government and had offered our services in terms of being able to provide that audit assurance. The response to which was, no, we're fine, thanks. We've got everything teed up from our end. So expectation is that there will be a level of compliance checking in respect of firms who have applied for and received wage subsidy, but exactly what that form will take and how rigorous or otherwise, we don't have experience of that as yet. So yeah, do watch this space. I would encourage you just to kind of monitor that, and if you've applied for the subsidy and it turns out that you haven't needed it, I think you're far better off being proactive and repaying the money rather than kind of necessarily kind of keeping your fingers crossed and hoping for the best that you don't get picked up on by way of the compliance audit. Okay, well, as I said at the beginning, this is the end of the 6-week BDO Back to Business webinar series. But that's not to say this is the last that you'll see from us. The next couple of weeks, we've actually teed up a couple of webinars on specifically focused on the not-for-profit sector. So this is in respect of back to the community, BDO Back to the Community. This is really aimed for those people who are working in the not-for-profit sector, or alternatively sit on the boards. And I know that each of us do play a large role in a number of community-based entities and not-for-profits or charities. So hopefully the next 2 weeks, same time, same place, the webinars will be of interest to you, and we'd love to have you back along. So from Natalie, James and myself, thank you very much for attendance. I hope you've got something from this, and yeah, feel free to contact any one of us in respect of any other queries we haven't quite addressed this morning. Thank you and have a great day. Cheers.